Her name was Katherine Morrison, senior analyst, 6 years of service, excellent performance record. Priya dialed her number at 9:14 on a Tuesday morning. No answer. She tried the next name on her list. No answer. Then the next. 23 people on the payroll of Hargrove Logistics had no badge access history. Not one swipe, not on day one, not on any day. No computer logins, no emails sent, no Teams messages, no record that any of them had ever set foot inside the building. 23 people on payroll for up to 9 years who did not appear to exist. Their salaries were real, every dollar of them. Someone was collecting that money. Hargrove Logistics was, by any reasonable measure, an unremarkable company. Founded in 1987 by a man named Gerald Hargrove in a mid-sized city in the American Midwest, it had spent 30 years doing what it said on the label: moving freight, regional distribution contracts, supply chain management for manufacturers who didn't want to think about logistics, the kind of company that kept the economy running and never made the news. By 2019, Gerald Hargrove was 71 years old, and his children had no interest in running a freight company. He sold Hargrove Logistics to a private ownership group for $14 million, stayed on as a figurehead for 2 years, and retired to Arizona. The company had 340 employees, 14 regional distribution hubs, and a clean bill of financial health. That health, everyone agreed, was due in no small part to Marcus Webb. Marcus had joined Hargrove in 2008, brought in as controller when Gerald decided the company had grown too large for informal bookkeeping. By 2012, Marcus was CFO. He was precise, organized, and absolutely fluent in the kind of institutional trust that makes someone indispensable. He attended every board meeting with color-coded slide decks. He knew every department's budget line by memory. He was the person new hires were warned about, not because he was cruel, but because he cared about the numbers in a way that could feel personal. Marcus Webb had golf trophies in his office. He had framed thank you letters from 3 different CEOs. He was the person who remembered everyone's budget numbers at the annual planning retreat without looking at his notes. He was the person who stayed late before every board meeting to make sure the slide decks were right. He had, by every visible measure, built his identity around being the most competent person in any room that involved money. He was the kind of person organizations promote not just because they're good at the job, but because losing them feels unthinkable. The institutional knowledge lives inside them. The relationships are theirs. The systems, over time, start to reflect their preferences. The company, in small and invisible ways, starts to become arranged around them. And he was good. Genuinely good at his job. That was the problem. When someone is both highly competent and deeply trusted, the checks that exist in theory tend to atrophy in practice. People stop double-checking the competent person's work because, why would you? The competent person is the reason things work. Questioning them feels not just unnecessary, but almost offensive. It implies a doubt that the evidence of years has never justified. That atrophy is exactly what Marcus needed, and he had cultivated it for more than a decade before he decided to use it. When the private ownership group that bought Hargrove decided to sell again in late 2024, this time to Pacific Growth Partners, a mid-market private equity firm, they expected the due diligence process to be smooth. The books were clean. The audits had passed every year. Marcus had seen to that personally. Pacific Growth Partners assigned a team of 4 analysts to the deal. The youngest was Priya, 26 years old, 18 months into her career, assigned the task no one found glamorous: headcount verification. Confirm that the people on the payroll actually exist and actually work there. She started making calls on a Tuesday morning in November. The process was straightforward. Priya had a spreadsheet with 340 names, departments, start dates, and direct phone numbers. Her job was to send verification requests to department heads and follow up on any that didn't come back clean. By Wednesday afternoon, 317 had been verified. Department heads confirmed the names, signed off on start dates, everything matched. 23 did not come back. Priya followed up. The department heads for those 23 names all said the same thing: in different ways. I don't know this person. This isn't someone on my team. She assumed a data entry error. It happened in acquisitions, legacy HR systems, manual entry, someone typed a name wrong. She requested badge access logs for the 23 names to cross-reference with physical entry records. The logs came back the next morning. 0 entries for all 23. Not a single badge scan, not on their listed start dates, not on any date since. Priya stared at this for a long time. She pulled up the HR system and opened the employee profile for the first name on the list. Katherine Morrison, Senior Analyst, Accounting Department, hire date 6 years ago. The profile was complete. Photo, emergency contact, direct deposit information, performance review history. She called Katherine Morrison's number. No answer. She tried the email address in the system. The account existed. It had been accessed. The last login timestamp was 3 weeks ago. She requested the IT login records to see where that login had originated. While she waited for IT to respond, Priya did something methodical. She pulled payroll records for all 23 names. She wanted to see how long they'd been receiving payments and what the total exposure might be. The earliest hire date among the 23 was 9 years ago. She started adding up the numbers. The total compensation paid to those 23 employees across all their years of service was $4,830,000. She checked the number 3 times, $4,830,000, paid to people no one in the building had ever met. The IT logs arrived the following morning. Priya had requested login records for all 23 employee email accounts, when they were created, when they were accessed, and from which device or IP address. What she received was not what she expected. All 23 accounts had been created from the same workstation, the same device ID. The logins happened in a consistent window between 6:45 and 7:10 in the morning, before the building's general population arrived. She looked up which employee the workstation was assigned to. Marcus Webb, CFO. Priya sat with that for a moment. Then she pulled the direct deposit records for all 23 employees. Every one of them deposited to a different account number. 23 separate accounts. 23 different routing numbers, or so it appeared at first. When she looked more carefully, all 23 routing numbers belonged to the same regional credit union. She submitted a subpoena request through PGP's legal team that afternoon. The credit union's response came back within 48 hours, expedited once the firm's attorneys explained what they were looking at. All 23 accounts had been opened on the same day, March 14, 2015. The account holder listed on all 23, Marcus Webb. The facts laid out were simple. Marcus Webb had created 23 fake employees in Hargrove's HR system. He had given them names, job titles, start dates, emergency contacts, and performance histories. He had set up email accounts for each of them from his own workstation, early in the morning before anyone else arrived. He had opened 23 bank accounts at a credit union and routed each fake employee's salary into those accounts, all of which he controlled. For 9 years, Marcus Webb had been paying himself $4.83 million in fake salaries. And for 9 years, not one person had looked. The question Priya couldn't stop thinking about: how? How does this survive 9 annual audits? How does a CFO pay $4 million to people who don't exist and no one asks a question? The answer, she would learn, was that the auditors trusted Marcus to prepare the records they were auditing. He was the control. He was also the subject of the control. Pacific Growth Partners suspended the acquisition immediately and called in an FBI forensic accounting team. What the FBI found over the following 3 weeks was not just the scale of the fraud, it was the extraordinary, almost incomprehensible effort Marcus Webb had put into maintaining it. Of the 23 ghost employees, 11 had received formal written performance reviews, not placeholder documents, detailed evaluations, with specific feedback about communication skills, project contributions, areas for development, each one signed by Marcus Webb, 2 of the ghost employees had been promoted, their titles had been updated in the HR system, their salaries had been increased accordingly, with approval documentation in the file. 1, employee number 7 in the system, a man named Derek Sutton, listed as a logistics analyst, had been issued a company laptop. The laptop had shipped to a P.O. box Marcus had opened in 2017 under a business name. The laptop was never returned. It was found during a subsequent search at Marcus's lake house. Think about what this means. Marcus Webb was not a man who took some money and hoped no one noticed. He was a man who spent 9 years actively maintaining 23 parallel identities inside his own company's systems. Every quarter, every year-end cycle, every audit preparation period, he was updating employee records, logging fake performance data, managing the operational fiction of 23 people who drew salaries, received performance reviews, got promoted, and never once walked through the door. The company's external auditors visited every year. Marcus was the one who prepared the documentation packages they reviewed. The payroll reports they received, the ones showing 340 employees receiving salaries, were produced by Marcus, reviewed by Marcus, and presented to auditors by Marcus. He was, in the truest sense, auditing himself, and every year he passed. There were moments where things could have unraveled. In 2019, when Hargrove Logistics changed ownership, a new group of executives arrived with fresh eyes. In 2021, the company upgraded its HR software platform and migrated all employee records. In 2022, there was an internal push to implement stronger payroll controls following an industry conference Marcus himself had attended. Each time, the ghost employees survived. Because Marcus was in the room. Because Marcus was the expert. Because when you are the CFO and you have spent 11 years being indispensable and precise and correct about everything, people defer to you on the very systems that might reveal what you have done. The FBI investigator who later testified at Marcus's sentencing described it as the most labor-intensive fraud I have seen in 22 years in financial crimes. He said it with something that sounded almost like reluctant admiration. Why? Why not simply take the money and stop? Why maintain the fiction year after year with such exhausting precision? That answer would come later, and it would reframe everything. The forensic accounting review took 6 weeks. The final figure, $4,930,000, paid to 23 ghost employees over 9 years. Every dollar traced to Marcus Webb's personal use. The breakdown was, in its own way, a portrait of a man who believed he had earned this. Home renovation completed in 2017, $340,000. A boat purchased in 2019, cash transaction through a private seller, $127,000. Transfers to a casino-linked account over a 5-year period, $212,000. Private university tuition payments for 2 children, 2018 through 2022, $380,000. The rest was spread across investment accounts, a second property, and a series of personal expenses that the FBI summarized in their filing as consistent with a lifestyle significantly exceeding the subject's declared compensation. Marcus's declared compensation as CFO, $190,000 per year. His actual take-home, including ghost payroll, an average of $726,000 per year over 9 years. He had been paying himself nearly 4 times his salary. The FBI also identified the trigger. In early 2015, Hargrove's board had conducted a search for a new CEO to eventually succeed Gerald Hargrove. Marcus had believed, by every internal signal, that he was the leading candidate. He had prepared for the role. He had told his wife he expected the offer within the quarter. The board hired an external candidate. They told Marcus he was essential in his current role and that they hoped he would remain a cornerstone of Hargrove's leadership team. 3 months later, Marcus opened 23 bank accounts at a regional credit union. The first fake employee, Katherine Morrison, was added to payroll the following week. Marcus was arrested on a Thursday morning, 11 weeks after Priya's first unanswered phone call. His attorney issued a statement saying he would cooperate fully with authorities. He was charged with 23 counts of wire fraud, 1 count of tax evasion, and 1 count of money laundering. Before I tell you the sentence, I need to tell you one more thing. Because when the FBI went into those employee files, all 23 of them, they found something that the forensic team had not been looking for and did not expect. Employee number 001, the first ghost employee added to the Hargrove payroll. The first account opened at the credit union, the name at the top of Priya's verification list. The first call that didn't connect on that Tuesday morning in November. Katherine Morrison. Her HR profile listed her start date as 1 week after the board announced the CEO decision. 1 week after Marcus was told he would not be getting the job he had been preparing for. Her title in the system: Chief Financial Officer, Designate. CFO Designate. A title that doesn't exist in any of Hargrove's official org charts. A title that had no job description, no reporting line, no defined responsibilities. A title that Marcus had invented and assigned to a person who did not exist, and paid $187,000 per year for 9 years. Let that settle for a moment. Marcus Webb did not simply steal money because he was greedy. He did not create a ghost payroll because he needed the income. His CFO salary was substantial. He created a fake version of the job he believed he deserved, gave it to a fictional person, and paid that fictional person nearly $2 million over 9 years. Katherine Morrison was not just a mechanism for stealing money. She was a monument to grievance. She was Marcus's private proof that he had always been right, that the board had made a mistake, that someone should have been CFO Designate, and that someone was him. Every paycheck Marcus routed to Katherine Morrison's account was a private act of revenge against a decision that was never reversed. He had been collecting that revenge, quarter by quarter, for 9 years. There is also this. The FBI found that the ghost employee's 401k contributions, faithfully deducted and matched by the company for 9 years, had been quietly accumulating in accounts Marcus had listed himself as sole beneficiary on. The total vested value at the time of the FBI discovery, $341,000. Marcus was 9 months away from the point at which he could have begun making legally structured withdrawals, small enough, spread across 23 accounts, to attract no scrutiny. He had thought of everything. Except Priya. Marcus Webb entered a guilty plea on all charges 11 months after his arrest. Federal sentencing guidelines for wire fraud of this scale, combined with the tax evasion and money laundering charges, placed Marcus in a range that his attorney spent considerable time arguing against. They pointed to his 16 years of otherwise compliant service. They pointed to his cooperation with investigators. They noted that he had no prior criminal history. The prosecution pointed to 9 years of sustained, deliberate deception. They pointed to the 401k beneficiary designations, evidence that Marcus had been planning an exit strategy for years. They pointed to the ghost performance reviews, the fake promotions, the company laptop at his lake house. They pointed to the fact that Marcus had removed himself from Hargrove's dual authorization requirement for payroll system changes in 2015, the same year the scheme began, under a change documented as an administrative efficiency update. He had disabled the control that would have caught him. Then he committed the fraud. The judge sentenced Marcus Webb to 11 years in federal prison. Restitution, $4,830,000. Plus the $341,000 in 401k contributions seized before withdrawal, plus interest. All personal assets traceable to ghost payroll funds were ordered forfeited: the home renovations, the boat, the lake house, the investment accounts. His wife was not charged, but the couple's joint assets were substantially encumbered by the restitution order. Katherine Morrison's employee profile was permanently deleted from Hargrove's HR system on the same day Marcus was sentenced. The title of CFO Designate was removed from every document in which it appeared. Pacific Growth Partners completed its acquisition of Hargrove Logistics at a revised valuation $9.2 million below the original offer. The fraud had existed on Hargrove's books for 9 years. The company's actual financial position, once the ghost payroll was removed, was measurably different from what the sellers had represented. And Priya, the 26-year-old analyst who had been assigned headcount verification because it was the part of due diligence no one wanted to do, received a commendation letter from Pacific Growth Partners' managing partner and a $47,000 discretionary bonus. She was promoted to senior associate 3 months later. She has said, in the time since, that the most disorienting part of the whole experience was how simple the discovery was. She made phone calls. She looked at badge logs. She asked IT for login records. She requested credit union information through legal channels. None of it required special training or a forensic accounting background or sophisticated investigative tools. She just asked whether the people on the list actually existed, and no one had asked that question in 9 years. I want to walk you through 3 things before we close out this episode, because this story isn't just about fraud. It's about the psychological architecture that makes this kind of fraud possible, and once you see it, you cannot unsee it. Marcus Webb was not a desperate man. He was not facing bankruptcy or personal crisis when he opened those 23 bank accounts. He was a high-earning CFO at a stable company with a comfortable life. What he was facing was something psychologists call a grievance loop, a sustained, unresolved belief that he had been denied something he was owed. Research on white-collar fraud consistently finds that a significant subset of financial crimes are not driven by need. They're driven by perceived injustice. The perpetrator constructs a moral accounting system in which the theft is not theft, it's correction. Rebalancing. Taking what was rightfully theirs all along. Marcus Webb didn't think he was stealing from Hargrove Logistics. On some level, he thought Hargrove Logistics owed him this. The board had made a mistake. Someone had to pay for that mistake. And if it wasn't going to be the board, it was going to be the company, $4 million at a time. One of the most striking psychological features of this case is the amount of work Marcus put into maintaining it. Writing fake performance reviews, logging fake promotions, shipping a laptop to a P.O. box, updating employee records, managing 23 parallel identities inside his own HR system year after year, while simultaneously preparing the company's financial statements and presenting them to auditors. This is not the behavior of someone who committed fraud carelessly and then lived in anxiety about being caught. This is the behavior of someone who had integrated the fraud into their identity, someone for whom maintaining the fiction had become, in a very real sense, part of their job. Consider the performance reviews. Writing a convincing performance review for a real employee takes thought. Writing one for a person who does not exist, a person with no actual work product, no real interactions, no meetings attended, requires constructing an entirely fictional professional narrative. And Marcus did this 11 times, for 11 ghost employees, every year. With enough specificity that the documents passed scrutiny, he was, in a psychological sense, a novelist. He had authored 23 characters and maintained their stories across 9 years of plot. And like any author who has lived with their characters long enough, the boundary between the fiction and the reality had likely begun to blur. Psychologists call this escalation of commitment. The longer you invest in a decision, the harder it becomes to walk away from it, because walking away means accepting that every previous act of investment was wrong. Marcus could not stop maintaining the ghost payroll because stopping would mean confronting 9 years of compounding decisions, so he kept going. He kept the fiction alive. He kept paying Katherine Morrison her salary. How did 9 years of annual audits miss $4,083 million in salary payments to people who did not exist? Because Marcus Webb was the person who prepared the records the auditors were reviewing. This is what forensic accountants call the segregation of duties failure, and it is one of the most common structural vulnerabilities in organizational fraud. When the same person controls a process and also controls the documentation of that process, The audit of that process becomes, at best, a review of documents the subject has already approved. Marcus removed himself from the dual authorization requirement in 2015 under the cover of an administrative efficiency update. He was the CFO. No one questioned it. It was his domain. The fraud didn't survive 9 years because it was hidden. It survived 9 years because Marcus Webb had designed a system in which he was both the thing being watched and the person doing the watching. Awareness is the first and most important control. The most effective fraud detection tool in any organization is not software. It is a person, ideally a young person, who has not yet been socialized to assume that senior leaders deserve the benefit of the doubt, who asks a simple question. Do these people actually exist? Priya asked that question. She made 23 phone calls. She looked at badge logs. She asked IT where the email accounts had been created. A 9-year, $4.83 million fraud ended before Marcus could collect the $341,000 in 401k funds he had been saving for a comfortable exit. If you work in finance, HR, or operations, the lesson is structural. No single person should control both the authorization of payments and the audit records of those payments. Full stop. And if you're listening to this and you've ever been passed over for something you believed you deserved, most of us have, I want to offer you this. The grievance loop Marcus built destroyed 11 years of legitimate professional achievement, cost him his freedom, his assets, and his family's financial stability. The promotion he didn't get was worth far less than what he paid to revenge himself for not getting it. Katherine Morrison, the fictional CFO designate, the monument to a decision Marcus could not accept, collected $187,000 a year for 9 years. She was never real, and Marcus Webb spent 9 years paying for the fantasy that she was. If this episode made you think about the workplace dynamics in your own life, the blind trust we extend to authority, the damage that unresolved grievance can do, BetterHelp connects you with licensed therapists online, on your schedule. The link is in the description. If you're a small business owner wondering how to structure your own payroll and financial controls to prevent exactly this kind of fraud, QuickBooks and Gusto both offer built-in dual authorization controls for payroll management. Links below. Subscribe if you haven't already. A new episode drops every week. And if you want to understand why betrayal happens, not just what happened, this is the channel for that.